Welcome to the Market Insight Call, where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. You know, Chris, often I play an economist on TV, or at least here on YouTube, but I thought a real economist would be a good thing to have given the debate on the definition of a recession. So joining us this week is Dr. Newman. Dr. Newman is a professor of economics at Florida Southern College. He completed his PhD at George Mason University, and his primary research interest includes Austrian economics, monetary policy, which we use extensively here, and he really focused on the late 19th and early 20th century history, or American economic history. He's a senior fellow at the Ludwig von Mises Institute. He edited The Progressive Era by Murray Rothbard. It's a great book where it really combines and shows how religion and government interplayed in the early 20th century. And he's also a recent author of the book of cronyism. Dr. Newman, thanks for joining us. First question is, given all this discussion about the definition of a recession, you as an economist, what would you say a recession is?
Well, first of all, thanks for having me on. It's a pleasure to be talking about economics. The question of a recession has certainly come up a lot in recent weeks, given all of the uncertainty going on regarding the economy and the stock market, recent GDP numbers. I would say, first of all, recession is when the output contracts, the economy gets smaller, and the economic pie is shrinking, so to speak. I think a good working definition that many countries use is if there's two consecutive declines in GDP between two quarters.
Right, and we here in the U.S. have the official definition, or I guess the call of a recession done by the NBER. Are you familiar with their process on how they decide what is a recession, what isn't a recession?
Yes. So the NBER, the National Bureau of Economic Research, it's technically a private organization, but it's very linked with government. They basically make they make the recession call. They decide when we enter a recession and when we leave a recession. Their business cycle dating committee, they look at a variety of indicators, not just GDP, but also payroll numbers, so employment, what's happening with real income, what's happening with retail sales, manufacturing, and so on. They're looking for what they call depth, diffusion, and duration. So how is the downturn affecting all of these sectors? Are they showing a similar phenomenon? And then they're going to make a judgment call. So they're essentially looking at objective data, and they are subjectively making a decision.
So it is subjective, and I wonder, with the amount of just partisan politics that are involved in this question, if we would hear their actual ruling on this maybe after November on the recent election, just to kind of stay out of that debate. Do you think that's possible?
Very possible, because that's usually what they do. So they first of all, they pride themselves on being apolitical, so taking the policy out of politics. Whether or not they do that is a different question entirely. And of course, when they make an announcement, will inevitably benefit one party or the other. For example, when the 2007-2008 financial crisis occurred, the NBER only decided in December 2008 that the United States had entered a recession starting December 2007. So it took them a year. When the COVID crash occurred in early 2020, it took them several months to declare a very short-lived downturn that happened in March and May. That happened before the November elections 2 years ago. And most likely they will continue to look through the data, and they'll make a decision probably at the end of the year, maybe early next year. They don't announce when their meetings are. They do everything very secretively. And especially in this current climate, the political climate, I don't think they're going to make an announcement until after the election.
Now, it seems that there's kind of this shorthand rule, since every country really has their own way of declaring that recession, that from my understanding, economics textbooks typically will say a recession's two negative GDP quarters, which we've had here on the last two. Has there, let's say since post-World War II, has there ever been a time where we had two negative GDP quarters and we not be in a recession?
No. So since 1950, we have not. So whenever there's been two consecutive quarterly declines in real GDP, there has always been a recession declared. Now, the only way out of this is if those quarterly declines get revised, right? So in future months, if one of those quarterly declines gets bumped upwards, then then we could expect there not being a recession. But given that there's been two quarterly declines in GDP, I would expect the NBER to eventually declare that there's been a recession, even if they say it's a very mild downturn. But at least from that indicator alone, it would be unusual for the NBER to not say there was a recession, assuming the data don't change.
So you just said mild downturn. So I think it'd be good to run through some of these scenarios. So often we're using the term hard landing, which the market would probably anticipate something where earnings are going to come down over 10%, versus a soft landing, something more mild, maybe it's only down a few percentage points. And the market has been rallying a lot recently, a lot based off of recent FOMC meeting where Powell seemed extremely dovish. You know, he said they've done a lot of things that really haven't shown up in the inflation numbers yet. And the market really implied that that's probably means that's that pivot they were looking for, that maybe they can slow down some of this monetary policy. And even though a lot of speakers came out and walked back against this and said, you know, Powell was a little out there and we are still going to keep trying to fight inflation harder than he implied, really, how are you approaching these scenarios? Do you have any probabilities you're putting on hard landing versus soft landing?
Yeah, so that's a great question. The discussion over hard landing or soft landing has certainly occupied policymakers. We think of a hard landing not just in terms of earnings, but we'd imagine a sharp increase in unemployment. Certainly an unemployment rate above 5%, at least other things equal, though current unemployment rates, something I hope we can talk about later on in this interview. There would be a sharp rise in unemployment, decline in real GDP, just a general stagnation. When we think of hard landings, we think of the early 1980s, the financial crisis. We talk about the COVID crash, though that was really due to something outside of monetary policy. When we think of soft landings, we could think of something such as the early 2000s dot-com bubble bursting, right? There was a big decline in certain stock market indices, but unemployment in real GDP, they didn't really move that much. So right now, markets have certainly been more bullish because they expect that the Fed has inflation under control and it won't have to keep raising the federal funds rate by as large of amounts as it has been doing. You mentioned 75 basis points right now, especially given the good news on the inflation front. Markets are hoping or expecting the Federal Reserve to only raise rates by, say, 50 basis points. The Fed is trying not to, regardless of what they might do, they're still trying to adopt a tough posture, right? So they don't want to come out and say that. But there's certainly a lot of discussion going on regarding the specific probabilities for a soft landing and a hard landing. One thing, it depends on what exactly is our time frame. Is our time frame by the end of this year? Is the time frame later on? I think right now the probability of a soft landing occurring in 2022 has certainly gone up since earlier in the summer. I would put that at about 30%. I'm still expecting there to be a downturn of some sort, given that we've seen a decline in real GDP and at least some basic preliminary data off of payroll. Real wages are falling. The stock market is still in a little bit of a rut. But later on, if we do have a soft-ish landing during this year, right? We're not entering a harsh recession. I think the probability of a soft landing or continuing to have that goes down, because right now markets are very focused on what inflation is doing in the short term. Inflation fell from 9.1% to 8.5%, largely due to gas prices. That's still very high. So there's still a lot of work that needs to be done by the Federal Reserve. So for right now, I'd say soft landing, there's about a 1/3 chance of that, this year. I would put it at a lower probability going into next year.
'Cause the market's certainly ahead of that. The market thinks the chances of soft landing are a little bit higher than that. I would say over 50%, just seeing by prices and forecasts for earnings expectations.
Absolutely. One of the things that we've been talking about on these rate cuts and money supply, I would ask, what really drives the change in the economy? Is it going to be interest rates, or is it really the effect that interest rates have on monetary policy? So to kind of clarify that question, could we see interest rates continue to go up, money supply continue to go up, and still have some positive traction, kind of that soft landing that the market may be anticipating?
So the discussion between interest rates and money supply has always been a big discussion point earlier on. If we were doing this interview 40 years ago, all we'd be talking about is the M2 aggregates. The Federal Reserve has not tracked those since the early 90s, and instead is mainly looking at the federal funds rate and some other interest rate indicators. So right now, markets are concerned with the federal funds rate. That's risen. It's about 2.3% right now. There's a very strong chance it'll at least go up to 3% by the end of this year. Money supply growth rates have fallen, considering the fact that the Fed is no longer adding to its balance sheet. The balance sheet has started to taper off. And given the abnormally high growth rates in the money supply over the past 2 years, about 40% in total, the year over year is declining. We could see a scenario where the money supply keeps increasing and interest rates rise. This could be due to the fact that the public is expecting more inflation. This is not happening right now, but we could see this start to develop if inflation lasts longer than usual. And also, generally, when the Fed does practice contractionary monetary policy, it really just slows down growth rates in the money supply. It very rarely contracts. If we look at over the past 40 years, M2 has not gone negative. Really, it's just a slowdown in the growth rate, right? So this is something that's important to keep in mind. And we could see this continuing, and that could prolong the boom. So again, that could lead to a soft landing this year. I know markets are certainly expecting that more than I am. I think, though, that really just kind of pushes it back later on into next year. So a lot of the turbulence it's always due to short-term fluctuations, but we always want to keep kind of the medium long-term picture in view.
So we have some negative GDP numbers, obviously, but we have 3.5% unemployment looking at the jobs report last week, where, if you believe the numbers, over 580,000 jobs added last month. Really, is there a historical time period you can compare this to where we're really adding jobs this way while slowing down? And on top of that, the market right now is really taking this view that they just want to get past this monetary slowdown of contraction. So when there's a strong jobs number, the market anticipates that we're not past that and that the Fed needs to keep going. But I know there's alternative views that when stronger jobs, you could have less inflation if there's more supply, even though the market anticipates it the other way around, that there's going to be more demand, more inflation. How are you approaching the labor market right now?
So those are all good questions. The unemployment rate is definitely seen as a strong side to some of the other negative figures, for the economy, and it's usually brought up by proponents who say, no, we don't have a recession. How could you have a recession with such strong job numbers? It is true that you historically, at least in the past several decades, you haven't had a recession with such strong job numbers, with the exception of, say, again, I mentioned the dot-com bubble. There wasn't really that much of a large increase in unemployment. There's a couple things to note that that should reveal why some of the labor market statistics are different than in the past. We are in a different world than we've been living in over the past 40, 50 years. Population trends are moving in the other direction. Labor force is declining due to lower birth rates and more people retiring. So one reason why the labor market is so tight is that, the labor, even in the face of strong demand from monetary and fiscal stimulus, labor force participation is still a couple percentage points below what it was during right before COVID, right? So this is definitely leading to an increased scarcity of workers. Now, one thing that needs to be mentioned about this unemployment situation is that, yes, people have jobs, but real wages have been falling over the past year, right? Nominal wage growth has been very strong. We saw that in the most recent payroll numbers, but real wage growth has been negative, right? So this is from the inflation eroding people's purchasing power. This is why we see consumers very negative and pessimistic, at least over the past several months, if not more than a year. They have a job, but they're making less, or they've stuck with their job, but they're making less. So I think you could see a recession call made, even if unemployment, only remains around that level or only goes up as high as 5%. Provided that other labor market indicators are as weak, such as the negative real wage growth. So if that continues, then that's definitely a sign of stagnation and living standards are stalling. Regarding the payroll numbers, there is over 500,000 jobs added. We say, yes, that's true. That won't get revised. What is this due from? What is this due to? Is this a sign of more inflation? Is this a sign of less inflation? It really comes down to, I'm an economist, so I'm always going to answer my questions like this, a question of supply and demand. What's causing this? Is it due to an increase in the demand for labor, right? From businesses that have additional monetary and fiscal stimulus, they're hiring more workers, right? The demand for labor is going up. If so, then that would lead to signs that would point to increased inflationary pressures, right? As more money is being spent in the economy, workers are getting higher wages, nominal wages at least, so they're going to go out and spend that. That's going to increase demand for future goods. That's what has some people worried. On the other hand, is this due to an increase in supply of more workers entering the labor force? If so, that would then suggest that an increase in production from those workers is going to swamp out any sort of demand conditions going on, and that would lead to an easing of inflationary pressure. So this is, of course, the big issue going on. My interpretation is that, well, we're continuing to dip into the reserve pool of workers. When unemployment is below the natural rate, which is what it has been, that means we're dipping into the reserve pool of workers. Businesses are only able to attract those workers when they're able to offer them higher nominal wages, at least. So I think it's a sign of inflationary pressures. But if those strong numbers continue, then maybe labor force participation will go back up. One thing I just want to point out regarding this is there have been more workers entering the labor force coming out of retirement, but that's because of high inflation, right? Their retirement savings have been eaten away. So it'll be interesting to see how all those dynamics play into each other over the next couple months.
So then what would you be looking for to really just consider that the bottom of the economy is? Are there any indicators you're saying, okay, well, maybe it's going to be at soft landing? What do you want to see before you say the economy is actually finally moving on from this kind of slowdown?
Yeah, so one thing to note when it comes to at least dating kind of the bottoming, the peak to trough, is you want to, when the NBR does that, they're looking at just when the bottom is and when we start recovering, not necessarily when we get back to normal, right? We think of the Great Recession, the bottom occurred in mid-2009. Various indicators didn't return to normal until several years later. We started recovering, but it was a weak recovery, right? What I'm looking for when we get back to normal, so to speak, all the way, whenever that may be, is when inflation falls down to 2%, right? Unemployment is at the natural rate. So right now in today's labor market, that's about 4.5%. And real GDP is growing according to potential. So real GDP growth is positive, and it's growing at about, again, in today's economy, this would be about 2.5%. Now, what I'm be looking for the bottoming, at least the bottom and the beginning of the recovery, so to speak, is to see inflation noticeably fall and job growth, the job growth to remain vigorous, real wages start to increase again, and the stock market starts to increase again on a noticeable level. So what I would really be looking for over the next couple months to see if something like that is occurring is another strong inflation report, strong being saying that inflation fell as much as it has been falling. Real wages start to reverse. So real wages start to go up. That'd be my big indicator on that. And to see the labor market also not experience any turbulence.
So we to go over the today's headline?
Yeah, Aaron does this to me all the time. I know it just got released, so I don't know how much time you had to go through it, line item. But is there anything in there that you thought was promising, that you liked, or anything that was a little scary for the economy?
So to just give a brief recap. So yeah, I was poring over the data, at least looking at it when it came out. I had my own predictions. I thought there was a chance inflation could continue to bump up or at least moderately fall. Markets expected inflation to fall from 9.1% to 8.7%. Core inflation to slightly go up to 6.1%. The market was beat. Inflation fell to 8.5%. Core inflation remained the same at basically 5.9%. So this was seen as a sort of an unambiguously good report. Inflation is easing. A couple things to note. This is largely due to a decline in gas prices, right? So we've noticed that if you've been driving a car, we've seen the numbers go up earlier in this year, and now the numbers have been going down. How much more they're going to go down is a different question. I'm not sure. Oil is trading roughly where it was before Russia invaded Ukraine. So I had been expecting this. I didn't expect the weight in the CPI basket to be that large, where it would literally cancel out other increases going on. Food prices have still been increasing. Shelter is still increasing. There have been services prices that have been increasing. So really the decline in the CPI, and it's not a decline in prices, it just means prices are growing less, has really been due to energy, largely gas prices, and a decline in used car prices, which if you've been following that market, I've been noticing there's been some softening there. So really the big promising thing is that CPI is declining. So inflationary pressures are easing. The issues is right now it's just concentrated largely in gas and used cars. So what we really want to see is for the inflationary pressures to be easing across multiple sectors, right? So we want to see food prices easing. Whether or not this will start to occur in the consumer goods, remains to be seen. I know commodities prices have been falling in agricultural markets. We'd also want to see rent easing. Would want to see various service prices increasing. Those have slightly increased the year-over-year growth rate since last month. So it was a good overall. Inflation has been falling. That's good. I don't want people to get too carried away with it, given that it was just so pronounced in a select number of components.
Chris, we call this the market insight. So we want to get into markets, and the economy obviously is an important component to that. And we're very cautious considering where we are in the economy. But the market has been rallying, whether it's a dead cat bounce or it's a legitimate rally that will be continuing on. We've been making some changes to the portfolio. One of them is commodities went negative on us. It's very deep negative, and we made that exchange and went to real estate and actually banked some of the gains that we had in there to raise a little bit of cash. But over the last couple of weeks, we've been adding value relative to our benchmark. And I've had a couple emails come through where I think people were trying to time the market, where they're saying, hey, should I get into this rally? A little hesitant to say. We continue to say just manage your risk. We've been leaning more towards technology and really leaning on our signals to push us in or out. And being that they were so deep, any churn in the market would show up pretty quickly and start making us go defensive. I think we would say that we want to be defensive, but we can't miss out on this rally. Anything you'd like to add?
I would just summarize that by saying the technicals from the market are what's keeping us invested. I think we tend to agree more with what Dr. Newman was saying, with the fundamentals are deteriorating a little bit faster, more than the market is probably pricing in. So that's the get a little bit more defensive that you're talking about.
Yeah, absolutely. Well, Dr. Newman, we really appreciate you joining us for this call, and hope to see you a little bit more often. If anyone liked this, go ahead and hit that like button, and please share it with those. And if you haven't yet subscribed, hit that subscribe button so that you constantly get the updates. We really appreciate you coming in this week, and we will see you in 2 weeks. Thank you.